You want your money to grow and also want to beat the market. But how do you find funds that actually deliver both? In this video, I will share two powerful growth funds. One has a long history of beating the market by using rule-based system, while the other rides momentum stocks and has crushed returns since its launched. And here is the catch. They both take very different paths, yet each fund ways to outperform the S&P 500. Stick around because once you see how these funds are built, you will understand why so many investors are paying attention to both. Hi, my name is Mutib Ahmed. I am chartered financial analyst and qualified accountant with a decade of investment banking experience, and I make videos to simplify investments and personal finance. The first fund is called Invesco Large Cap Growth ETF, which ticker is PWB. PWB follows dynamic large cap growth IntelliDex index. Don't worry about the name. The idea is simple. The fund looks at a big US companies and picks the ones that shows the strongest signs of growth. It does this by looking at different factors such as sales growth, profit growth, stock momentum, and other metrics. The ETF was launched back in 2005, so it has almost 20 years of history, and today its size is $1.3 billion. Now, let's talk about the performance of PWB. Over the 1 year period, PWB returned about 25%, crushing the S&P 500 return of 16%. Over 3 years, it's up 26.4%, again stronger than the S&P's 19.4%. Over 5 years, PWB returned 16.7% compared to S&P 500 14.6%. Over 10 years, the returns are very close of 14.9% versus 14.5%. And since its launch, PWB has averaged 11.3% per year ahead of S&P's 10.6%. In other words, over both short and long term, PWB has shown it can edge out the market. If you like the video, please hit the like and the subscribe button. Like every fund, there is a cost to own it. The expense ratio of PWB is 0.53%. That means if you invest $1,000, you will pay about $5.3 a year in fees. PWB comprises of large cap growth stocks and large cap blend stocks, contributing about 75% of the portfolio, plus a slice of mid cap growth stocks of about 17%. So while PWB focus on large cap companies, it sprinkles in some mid-sized players too. Sector-wise, PWB is heavy on tech with allocation of almost 38%, with a solid chunk of financials of about 15%, industrials about 15%, and communication services about 11%. And here where it gets interesting. The top holdings aren't just usual Magnificent 7. They are a mix. Alphabet with 3.75%, Palantir with 3.5%, Broadcom 3.5, Walmart 3.4, General Electric 3.4, Intuit 3.35, and so on. So unlike tech-dominant ETF, PWB provides exposure to retail and industrial. The big idea here is balance with an edge. PWB isn't just blindly tracking the market. It uses a rules-based system to pick companies with strong growth signals and reshuffles 4 times a year. That's why it has been able to slightly outperform the S&P in most periods. So here's the takeaway. PWB gives you a way to own growth-focused basket of large companies with exposure to both big tech and other sectors like retail and finance. It charges a bit more than plain index funds, but in return, it offers a chance to beat the market, and historically it has. If you are looking for a growth and don't mind a little extra volatility, PWETF could be a smart addition to your portfolio. Now moving to second ETF, and that is Fidelity SAI US Momentum Index Fund, which ticker is FUMIX. It was launched back in 2017 and it has grown to about $4.6 billion in assets. Its main goal is to match the returns of MSCI USA Custom Momentum Composite Index, a special index that only includes US stocks with a strong upward momentum. The fund strategy is straightforward. At least 80% of the money goes into momentum stocks, You have to know that momentum investing is based on a simple idea that stocks that are winning tend to keep winning, and at least for a while. Think about when a company like Nvidia or Netflix is in spotlight and investors keep piling in. Momentum funds capture those types of moves. And of course, it's not a risk free. Momentum stocks can fall harder when the trend actually breaks. But over the time, it has been a proven strategy to beat the market in many periods. One reason investors like FUMIX is its low cost. The expense ratio is 0.13%. That means for every $1,000 you invest, you pay only $1.3 per year. Compared to most mutual funds, that's a dirt cheap. Let's talk about the performance. Over the 1 year period, FUMIX returned about 20% compared to 16% for the S&P 500. Over the 3 years, the fund gained 22%, again higher than the market's 19.4%. Over the 5 years, the market slightly edges it. FUMX returned 14% versus the S&P 500's 15%. But here's a kicker. Since inception in 2017, FUMIX has averaged 15.8% per year, way ahead of S&P's 10.6%. In other words, momentum works and this fund shows it. Where does FUMX put your money? Right now, the biggest chunk goes into financials with 24%, technology with 22%, followed by industrials of 12%, consumer staples of 11%, communication services 9%, healthcare 7%, and consumer discretionary of 7%. There's a wide spread across industrials, not just tech. The top stocks are names you will recognize. JP Morgan about 5%, Broadcom about 5%, Netflix 4.7%, Palantir 4.3%, Visa 4.2%, Berkshire Hathaway 3.4%, Walmart, Philip Morris, GE Aerospace, and GE Vernova. It's not just about chasing the Magnificent Seven. You get a mix of banks, tech, retail, and even consumer staples like Philip Morris. FUIMX gives you a way to ride market trends without trying to guess which single stock will win. By owning a basket of momentum leaders, you spread your risk but still capture the power of trends. It's beaten the S&P 500 since its launch, charges almost nothing in fee, and give you exposure across different sectors of the US economy. So here's the takeaway. If you want a low cost way to invest into momentum, FUMX is worth a look. It has a proven record of outperformance since 2017, spreads your money across top performing sectors, and holds some of the most recognizable companies in the market today. Like any momentum strategy, it can feel bumpier when trends reverse, but for a long-term investors who want a growth, it can be a powerful tool in your portfolio.